All right, joining us now, Tennessee Senator Bill Hagerty. All right, Mr. Hagerty, good to see you again, sir. So, listen, you just got a plug. The great Kevin O'Leary plugged you and your new banking bill on this show within the last 5 minutes. I think that should make you happy. I don't know. There's a smile. Anyway, in plain English, can you explain your new banking bill that's going to fix everything?
Certainly, Larry. It's great to be back with you again, too, and it was wonderful to be with Kevin yesterday. What Kevin was talking about is an effort to try to address the intense pressure that's on the regional banks right now, and frankly, the massive uncertainty that federal regulators have created as they've come in and I think completely mismanaged the auction of Silicon Valley Bank, the way they've handled Signature Bank. They've created a tremendous amount of uncertainty in the marketplace, and you've seen what's happening now, the pressure that's on the regional bank industry. What it does is it addresses one of the issues that Kevin raised. Over the next 90 days, it actually greenlights the merger of these banks as long as the resulting bank is going to be well capitalized and not poorly rated. I think that will facilitate the process that he's talking about, and it will allow price discovery to happen right away rather than having to stand back and wonder if regulatory approval is ever going to happen. That's a huge break on bank mergers right now.
So, Senator, I don't mean to be rude. I just want to clarify, because the FDIC, which is run, you know, it's like a woke agency now, but they don't want these mergers. Like, they stopped mergers, and then they finally had to go back to J.P. Morgan. So is there a problem there? Is that what you're gunning for? Is that what you're aiming at?
Yep. Larry, so perceptive. That's exactly the problem. And the uncertainty of dealing with the FDIC is a real cloud in the marketplace right now. And if you need to achieve a merger, you want the type of efficiency that will result and want this market to settle down, we need to step in from a legislative standpoint and address it. And that's what this is aimed at doing.
And the next step?
The commercial deposits that Kevin was talking about, the non-interest-bearing deposits, which are basically payroll accounts. That's the biggest concern right now that the banks have. On a temporary basis, what we want to do is just provide a backstop so that those accounts don't run. The same tool was used back in 2008 to great effect, and that's the objective here, a temporary fix just to calm the markets right now. Some of my colleagues are calling for massive increases in FDIC insurance, et cetera. Yeah. That's not the direction to go.
Well, that's just my question. It sort of sounds like, look, these are uninsured deposits. I understand that. They're above $250,000 in many cases. I understand that. But are you going to cover it? Is this a big government bailout?
Well, I think what it's going to do is just stop the concerns that exist right now among many of the middle-sized companies that are managing their payrolls, and they can't go missing a payroll. And it's the most painful point that really well-functioning regional banks have to deal with. The fact is that these too big to fail banks are in a position right now where they've got an implicit government guarantee. Their loan officers, even though they're being told not to, are reaching out to the regional banks that have great accounts, and they're trying to recruit those banks, those regional banks' clients to leave. This will help address that concern.
Well, Kevin says, or has said, regional banks can't survive. I mean, if the market moves the deposits out of them for whatever reason, I don't know what you're going to do. I mean, I hate to see the FDIC at the end of the day become more powerful, Senator Hagerty.
I agree with you.
I'm not a big friend of the FDIC. I mean, I think their functions should be limited and basic. I don't want to blow them up. I mean, I see people saying they should guarantee everything. I've even seen Republicans say that. That's not where I'm coming from.
Nor am I. The other thing that this bill does, Larry, is it changes the least cost test. It forces the FDIC to take into account the long-term effect of failing a bank. If you look at what they did with SVB, they put us into uncharted waters because nobody knew where they stood on Monday. What we want these auctions to do is achieve a result. SVB actually had 2 bidders, yet the FDIC turned one down because they said the board hadn't approved it. Come on, I asked Marty Greenfield, who runs it, I said, did you call the bank? Did you get the board's approval? No answer to that. And then when I asked about the next bid, he said, well, the consideration wasn't adequate. I said, well, what was your counteroffer? He said, I'll have to get back to you on that. This is ridiculous. They should have closed that. We have been talking about a contained set of risks. Instead, they opened the entire marketplace up. Right. That's why we're having to address this now.
Senator Bill Hagerty, Tennessee. Thank you, sir. We appreciate it.
Great.